affect China, they affect the whole world, right? So you say that when US the world cashes cold, because whether you hate or like the US, you can't ignore them. China is joining them. So now whatever happens to the US and China, you should be worried about it because it will affect all of us. So if growth is slowing down in China, the growth in the world will slow down, including in Africa and including Nigeria. And when growth is slowing down, consumption of energy will slow down, which means the price of our crude oil will go down. If it goes down and it falls below our benchmark in the budget of $57, our deficit would increase even further. We'll have less money to spend on infrastructure in Nigeria. We'll get poorer because our growth rate is lower than growth in population. So these issues are connected. So you have issues to do with insecurity, and I won't go into that. Every person in this room knows a lot about insecurity, and they can have their own analysis. Digital economy, also raising issues around diplomacy. So you find France says, oh, we're imposing taxes on digital economy. America says, no, it's not digital economy, you're attacking our businesses. Because they have the big guys, right? The big tech companies are mostly American companies. So if you're going to do anything in that space, you have to watch how US will react. They haven't reacted to us. In our Finance Act, we have something for digital economy, but America is like, what's the size of the digital economy in Nigeria in the affairs of things? It is a drop in the ocean. So they are reserving their energy for bigger conversations. Then the economy, there's regional integration, right? Issues to do with the ECOWAS, the adoption of eco-currency, and also African Continental Free Trade Area. All these issues connected would have impact on our economy. Border closure, real interest rate is negative because, whenever you have real interest rates being negative, it's a problem for investments, which is what we need for savings and investments. Inflation is going up. Monetary policy of CBN talking about loan to deposit ratio at 65%. They're saying that people can't, play in the open market operation anymore, which is why interest rates are going down. And then you have stuff around the cash reserve ratio that's been increased from 22.5 by 500 basis points, which means banks have less money to play around with, right? Essentially saying banks must keep their more money with the CBN at 0% interest rate. What that does also is raises the cost of deposit to banks. And if you raise the cost of deposit, you also, of course, impact on their ability to reduce the rate at which they lend. If the rate at which they lend is not coming down, then businesses can't borrow to do real businesses. Business confidence is very low. The capital market has been struggling. And then we have ERGP is coming to an end this year, so we have to find the succession for ERGP. And then there have been stuff around Agenda 2040, Agenda 2050. To be honest, usually when we come up with these plans, they're brilliant. The problem is how do you implement? I remember, even during Abacha time, there was something about Vision 2020, or was it 2010? There was another one. When they said 2020, it was like it will never come. We're already in 2020. We are poorer than we were 20 years ago. So the other issues, COVID-19, I told you about it. There's minimum wage. We have new leadership at the FRS and the Joint Task Board, and all manners of things. I spoke recently to I had a session with the finance minister, and she said, well, Mr. President is even wondering, this GDP doesn't even make any sense to our people. Should we not focus on the sustainable development goals? And yeah, that's brilliant. If only you know how to measure it and you measure it objectively. It's not the one you measure for politics. You come and stand in front of the media and say, ladies and gentlemen, Nigerians are happy about our government. What does that even mean? Nigerians love us. What does it mean? Nigerians support us. Can you not measure progress, poverty level, education, human capital development in particular is so fundamental that you can't get anything done without it. And then infrastructure will follow. So some of the emerging trends around taxation, there are quite a number of them. So DOTAS is Disclosure of Tax Avoidance Scheme. Countries like the UK are saying, when you finish doing your tax plan, you come and tell us about it. You know, that's quite interesting, right? So you go yourself and say, dear government, I have decided to structure my affairs to reduce my tax liability, and here's exactly what I have done. By law, you must tell them. Okay, so I hope nobody will go and copy it and bring to Nigeria. So there's unexplained wealth order. If your wealth is above a certain threshold, government can ask you to explain. Interestingly, Nigeria was a signatory to the treaty in Ethiopia. Yet, Nigeria has not even introduced a law or an order. And countries like the UK, where corruption is a lot less, already have it in place. And it's systemic, right? To be able to fight it, you need structural issues. You need systemic reforms. Why should I go to the passport office today and have to pay more than the official amount? Why do I have to pay a little bit more to get my driver's license? So why is it that a policeman can stop me and say, oh God, you have been arrested for doing nothing? And then they say you have to pay 20,000 to get yourself billed. This, when they brought out the report by TI to say corruption level in Nigeria has gone up than previously, government became very defensive. Somebody said, you know, you only ask all these people that are not happy about us fighting corruption. How can you say that? That they are PDP people who gave the responses to the survey. Whenever you have a problem, the first step towards solving it is the acknowledgement that indeed there is a problem. And then you can look for the solution. If you are in denial, you haven't started anything yet. So we have CFC is current control foreign corporation, where you look beyond the immediate entity you are dealing with and look at where they're being controlled from. We have FATCA in the US, Foreign Account Tax Compliance Act, particularly for those of us who like to go and give birth in the US, right? It's good to have American citizenship, but it comes with a big price, America is one of the only two countries in the world, the second being Eritrea, whereby you do not break your tax tie. If you like, go to the moon and stay there for 10 years. Your tax obligation with the US continues. The only way you can avoid that is to denounce your citizenship or to be poor. So if you are if you are below a certain threshold, America says your problem is already complicated. You don't need to pay taxes. Otherwise, if you're a permanent resident or a citizen of America, you must file returns on it. But of course, people were not filing. America found out that they were not filing. They estimated they were losing over $100 billion annually. But if you're the US, you can make a law and tell the whole world. I went with some banks to see the CBN governor at the time. We said, well, we need to comply. And the CBN said, what's my problem with Americans' law? I said, okay, it's your problem, because if you don't do it, America will impose a penalty on any inflow or outflow that passes through the American system, right? And the only way you can do banking without using the Americans' financial system is to do community banks. Any bank that is bigger than a community bank, you will need the American financial system, isn't it? So people are having to comply, including Nigerian banks. So we have diverted profit tax. So this is, the taxman says, if I don't understand what you are doing, but I'm not comfortable with it, I would assume that you're trying to divert the profit from my territory and ask you to pay the tax first. Why I find out whether indeed you were trying to divert the profit. So they call it diverted profit tax. There's guilty. So, yes. Guilty is a US, actually even the US themselves are worried about all these things moving around. So this is global, intangible, low tax income. The likes of Googles, the Apples, the Amazon, powerful companies, some of them more powerful than countries. There was a time that Apple had more cash than the US Treasury. As of today, Apple will have somewhere around $250 billion in cash. As of today, if not more than that, Apple. Despite that, Apple decided to borrow money in the US to fund their US operations. How can you have this kind of money? See, the money that Apple has, if they just give us 10% of it, our budget will balance, right? You know, 10% is $25 billion. That's more than the federal government's budget. And then you borrow. But what happened? Apple did their maths and realized that if they bring in cash into the US, the tax they will pay on it is more than leaving the cash outside, borrowing in the US, and getting tax deduction for the borrowing. So they borrowed. Right, so it's inherent in the human nature to be selfish. You think about yourself, but that's okay, provided you think about others next. If you think, there's only a problem if you think about yourself first, next, and last. Then now you need a deliverance. Then you have cooperative compliance. Taxpayers hide. Tax authority trying to find them. It costs money to hide and money to find. Neither the taxpayer nor the tax authority benefit from that cost. So the concept is, how about taxpayer, you stop hiding. So me, tax authority, I won't have to spend money finding you. Let's save ourselves money. So we call it cooperative compliance. It's built on trust. Let's trust ourselves to do the right thing. I know it will not work in Nigeria yet, because even some people don't trust themselves, let alone trusting other people. There's base erosion and profit shifting. There's transfer pricing. There's tax inspectors without borders, where you can now have, I think they borrowed the concept from Doctors Without Borders. So you can have foreign experts join the FRS to do audit of your company. Because for some of the transactions, they're so complex. Our tax authorities are not prepared, they're not knowledgeable, they're not skilled. It's the situation of the more you look, the less you see. But if you find somebody who has the experience, they've done it in Asia, in Europe, in the US, before you finish, they know what you're talking about. Bros, I understand your transaction. Can you please pay your tax? So that partnership is under the framework of tax inspectors without borders. Common reporting standard is how we get the rest of the world to disclose what you have elsewhere to your country. Right. So if you have bank accounts anywhere around the world, I'm sure by now you would have received a letter that says, we need to disclose your financial transactions and balances with your tax authority. If you agree, sign. If you disagree, please come and close your account, because they can't deal with it, with the problems. So which means government can easily get what you have anywhere in the world. Then there's country-by-country reporting, where companies, multinationals, are required to at least disclose what they do by country. Because if you look at the aggregate, sometimes it doesn't tell the full story. Then you have team capitalization, which is one of the things in the Finance Act. Government says you cannot just deduct interest on connected party loans, because interest is tax deductible. You erode the tax base. Why don't you use equity to fund your business? So we're going to limit you. You can only deduct 30% of your EBITDA, any before interest, depreciation, amortization, and tax. Anything above that, you will not be able to deduct for tax purposes. Then tax intelligence. The taxman is using tax intelligence. And I said to the FRS, see, I do not know of any country in the world where the citizens are so hyped. They say, we can't wait to pay our taxes. Unless you are Warren Buffett and Bill Gates, right? Those are the two guys I know who have genuinely asked government to tax them more. Normal people don't ask government to tax them more, right? Normal people want to keep the money that they make. So, but the point is that the reason why people pay taxes in other countries is not just because the tax system works or government works or they can see infrastructure. They are afraid of the consequences of not paying taxes. Why are they afraid? Because government has their data. There are countries around the world today, not even going too far. In Rwanda there, Rwanda government says, you know what, don't worry about filing your VAT returns. We'll prepare it for you. So at the end of the month, we'll show you your VAT return. You just need to confirm that it is correct. This is Rwanda, because if I say the US now, you say it's too developed. Right. That's the power of tax intelligence. Everything is connected in this world. You use your card, you buy air flights, you use a banking transaction, you are online on Facebook, you're putting data out every single day. Those data, governments will get a hold of them, either directly or indirectly, and piece it together. If your stories are not adding up, bros, I know you have 2 properties in Lagos, you have 2 in Abuja, you have 1 in Dubai, 1 in Canada. How is it that in your tax return you've only paid 20,000 naira? It's not adding up. I just need you to explain to me, maybe there's something I'm missing. And I can see your bank balance in pounds, dollar, and naira. Okay, so Nigeria is beginning to think about it. You know, that's why they talk about the Financial Intelligence Unit, even though there's still not that robust understanding of how to connect the dots. Then we have the Finance Act, we have bank freezing order, we have informal tax, we have DAXIS in Europe. And this is about if you do anything, structuring, arrangements, avoidance schemes affecting the EU or a company in the EU, you have to make some disclosures. And of course, VADs and VOAs that we had recently. So, in closing, how do you manage your tax affairs? I just have these 4 simple but very powerful steps. First and foremost, seek to understand. If you do not understand, 1, you miss out on opportunities. Number 2 is you expose yourself to risk by not knowing. So knowing is the very first step. Then assess the impact. Now that you know, how does this affect me? How does it affect my employees, my suppliers, my customers, my industry, the prospect that I have? And then implement the ones that are relevant to you. And then review and revalidate. After you've implemented, I've seen, I did my own little, analysis recently. I went to the mall on Sunday because I know that they would have reflected the 7.5% VAT. So I bought a few items. And I realized that all they did was to just amend the VAT rate from 5 to 7.5%. They had not thought about the fact that there were items that were liable to VAT before that are no longer liable to VAT now. For example, bread. Bread was previously liable to VAT, but now no longer liable to VAT. So one of the things, there was a session I had for Access Bank, I think it was yesterday or the day before, with Bismarck. And we said one of the things people can do is maybe just print out, it's like a page or 2. Just print it out, put it in your pocket or put it on your phone. Anytime you go and buy anything, say, bro, see on this list. Yeah, otherwise Nigerians will just continue to do whatever they're doing. But it's at your own cost. Right. Okay, so my final thoughts. A lot has been said, but in the end, I like this quote so well because it's so apt, by Margaret Mitchell. And she said, death, taxes, and childbirth. There's never any convenient time for any of them. Absolutely right. Thank you very much.
Thank you very much, Mr. Oyedele, for that very insightful presentation. We will be taking questions now very quickly for the next 15 minutes. So please, if you have any questions, please signify by a show of hands, and I'll come around and take all the questions, and Mr. Oyedele will have the opportunity to answer all of them. Thank you.
Good morning. My name is Olanrewaju Hanofi. Apology, I came in a bit late, but when I came in, I met you saying that the new finance act, as it concerns VAT, does not affect, a number of goods and services in the country. But from my own observation, in the last 2 weeks that the bill took effect, I observed that the prices of items just went up, some by even 20%. Because it appears some of the traders leverage on the increment on the VAT to increase the prices of their goods. And I'm not pretty sure that the government has anything in place to control this. So I don't know how one addresses this, because it affects we that the government refer to as the poor in the society that will not be affected. Thank you.
Okay.
Please introduce yourself before asking your question.
Thank you. My name is Ayola Onobokun. I work with Axela Limited. Uh, Thank you very much, Taiwo, for your presentation. Simplistic in presentation, but of course, weighty. And I'm happy to have passed through you. A few questions about the Finance Act. To start with the VAT. So today, Nigeria seems to adopt the origination or the destination principle, particularly about cross-border tax. But of course, our reality today is that when you do foreign transactions, sometimes you may have VAT loaded on this foreign invoice. So today, I don't know that all the amendments we've made to the Finance Act seems to capture the prospect of a double taxation on Nigerian entities, resulting from some tax jurisdiction, trying to enforce the origination principle when they deal with Nigerian entities. That is on one hand. The other question has to do with what we are trying to do with the Finance Act by trying to prevent, tax evasion when foreign entities deal with us. So we are trying to say we are introducing significant economic presence as part of this whole digital taxation. Does this then mean that every other foreign transaction, be it digital or not, will be captured by these new provisions of the Finance Act? That's one question. The third one is about the issue of EBITDA. EBITDA sounds simple, but our concern has always been, would we have instances where FIRS start to divine their own EBITDA? In other words, would you have a tax EBITDA definition or the strict accounting EBITDA definition, even though for reporting purpose? Unfortunately for us, we do not have EBITDA as a line item, even in the income statement. So you still have to work out what is EBITDA and all of that. So for me, I think there are still a number of concerns about what we have done with the Finance Act, and I think it's important for us to start to talk about some of these issues because that's the practical side of the implementation. Thank you.
My name is Abayomi Adebanjo, Main One. My question, born a bit a corollary of his own, is relation to the significant economic presence. Is there a, which I think must have been driven by BEPS, the base erosion and profit shifting that has been adopted on the EU. So is there definitional parameters for what constitutes significant economic presence? That's one. And then the second one is, you alluded to the self-charging of VAT, even when VAT is not on an invoice. My question to that is that, especially for MSMEs, right, or individuals artisans that perform, sundry services that might be a vertible service, what would your advice be when you're dealing with such persons? When, as a company or a corporate, you're dealing with such persons, are you saying that you're going to self-charge yourself and remit? What would be your advice? I would like to.
We'll stop with the questions for now, give him the opportunity to answer these sets, and if he has more time, then we'll take the next round of questions.
All right, thank you. So the first one is prices of items have gone up, even me to have noticed it. People were just waiting for the excuse to raise their prices. Because if you think about it, 2.5% VAT, the maximum increase should be 2.5%, not 20%. So this is something that Nigerians do a lot. Also, whenever they want to remove the subsidy on fuel or adjust it, you always wonder whether transportation cost is all about the fuel price. So what I'll say is, first, again, the understanding is the starting point. So first, understand the items that are liable to this VAT and therefore affected by the increase. And then just ask questions. So last time I came, this was 50 naira. Why is it 70 now? You say it's VAT. See, Oga, VAT is 2.5%. This increase is more than that. Can you tell me something else? So if you have more people asking those questions, and where they have competitors, go to someone else who is more rational, so that the market can also correct it in due course. So for some items, you will not notice immediately. Like if you buy a recharge card, they still sell them 100 naira, 500 naira, but it's running out faster than before. Yeah, because what they've done is is VAT inclusive, so it has to run out faster. Same thing with your data. Number two is, so Ayola said that the destination principle seems to be like what the FRS has adopted, but does that not in itself create double taxation? Most countries around the world also believe in the destination principle, so which means anything that originates from their territory and going to another country is treated as an export and therefore is zero rated. What you should never have to deal with is to pay tax of the originating country and also pay VAT in the destination country. That's really double taxation. And I think the way Nigeria has now interpreted their own VAT principles and coded it in the Finance Act does not, in my view, create double VAT for you. If you have to pay double VAT, it will not be Nigeria that created it. It will be the other country where it's originating from, right? Then, significant economic presence for digital taxation purposes. Does it mean every foreign transaction will be liable to Nigerian tax? So there are three categories, or let me say two. So there's the digital economy, digital transaction by foreign providers, and then there we have providers of services. So Nigeria has technically created both a digital and service PE in Nigeria for foreign providers, if they have significant economic presence. But what does that actually mean? The Finance Act says that the finance minister may. I'm not a lawyer, but if you just apply everyday English. So when they say the finance minister may define, which means the finance minister may decide not to define. It's not like shall, right? Shall would have been compulsory. So which means, as of now, the law has started already, but there's no definition by the finance minister. So we're going to be stuck with the FRS's definition. But last week I was in Abuja with the FRS management. They were doing their retreat. And then I also had meetings with the World Bank, and they said that they are helping Nigeria and the finance minister to define this significant economic presence. Apparently, they took interest in significant economic presence. And they said they're going to advise the finance minister to use the OECD prescriptions. So based on the OECD prescription, you have things like, if you have, it could be based on threshold in terms of the value of income that you earn. It could also be a threshold based on the number of customers in that country. It could also be things like, do you have a website in local dialect? So Google, for example, can run away because they have Google Yoruba. So those thresholds are the things that Nigeria has to define. In the meantime, I would recommend that if you are dealing with this in your organization, please use the OECD standard. Because if you have to go to court as of today, when government hasn't defined it, and government decides to define it, or maybe FRS, who is not the authorized body to define it, if they decide to define it in a ridiculous manner, you go to court, guess how you're going to defend yourself? You say, based on international best practice, global standards. That's what I've adopted, and that will fly. EBITDA, would it be the accounting definition, or would we have to be at the mercy of the FRS to tell us what it is? Now, the way the tax laws are normally interpreted is that if a term hasn't been defined in the law, it will take its ordinary meaning. If it's a technical terminology, it will take the technical interpretation. So the authority for accounting terminology is the International Federation of Accountants, IFAC, in their ISB of IFRS publications. So if you read IFRS, whatever you make of it in terms of the definition of EBITDA is the definition that you can sustain should there be a dispute. FRS is working on their guidelines for how to implement the Finance Act. At the end of the day, if we bring out the guidelines, you can disagree with them. if their views are so unreasonable. What constitutes significant economic presence? I already explained that. Then reverse charge on supplies from artisans and small businesses that are not registered for VAT. How do you deal with that? So already the Finance Act envisages that large firms will be dealing with small firms. So if a small firm under 25 million is not registered for VAT, they can't charge you VAT and they supply you or they do maintenance for you, for example. They will not put VAT on it. But maintenance services is a VATable service. To the extent that you, the recipient, is not a small firm, i.e. your turnover is more than 25 million naira in a calendar year, you must self-charge yourself the VAT. One of the things the FRS guys have been discussing with me is that they think that majority of Nigerian businesses now will be under 25 million. People will just make sure that it's under 25 million. And I do not deny that. That risk is very real. So what I told the FRS is, here's what you can do. By the way, to get the threshold was not easy. So the first time I mentioned the threshold at the committee, everybody thought to say that because I had some data. The International Monetary Fund had come to Nigeria and reviewed the FRS. And they found out that in 2018, 97% of the VAT revenue was contributed by 3% of the taxpayers. FRS had about 4.1 million taxpayers in their tax nets. 4.1. Some of them, majority of them enterprises who have to register for VAT. Only 3% of them contribute 97% of the VAT revenue. So the other 97% contributed 3%. If anybody was taking record of the cost of collection, it would be more than the 3% they contributed. So it wasn't making sense at all. So it was that data. So the point was, as the taxman, why don't you focus your efforts on the guys who have the ability to comply and then leave all these small businesses alone so they can grow? So that was then extended to CIT to say for CIT as well, your CIT will be 0%. FRS says, well, we are worried. I said, look at your data, don't just be worried. They told me last week at their retreat that companies that are below 20 million turnover across Nigeria only contributed 5 billion naira in income tax. Now, 5 billion naira is very small, right? In the affairs of what you ask the FRS to collect. I said, here's what you need to do. As of last year, people did not have the extra motivation. There was some motivation to make sure their turnover was under 25 million because there was no law at the time. That's your starting point. Anybody who was above 25 million as of last year, you know who they are. If they fall below 25, you say, bros, come, last year you were 40. What happened suddenly? But the guys who had always been under 25, it was recession. Yeah, which is okay. Yeah, you can explain it. But if you're unable to explain it, I'm doing an audit on you. So I think essentially for us, the large firms, self-charge yourself. For the small firms, whether they are lying or they are being truthful, it's not your business. You shouldn't start auditing your suppliers. You have no abilities, and in fact, it will be a waste of your resources to try to do that. One thing I need to mention, though, this is in conversation with one of my clients, I had not even thought about something like that would happen before, was last year they were dealing with a firm, and this firm wasn't deducting withholding tax on them. FRS went and audited them and said you should have deducted withholding tax. They said FRS were sorry. So they wrote to this company and said, you did not even tell us that we should deduct withholding tax. So they asked the company to give the withholding tax, the penalty, and the interest. They are in court now. It's so unbelievable that you feel like somebody has the obligation to tell you what to do, rather than you knowing what you're supposed to know. So one of the things I'm advising people to do is, in dealing with small companies, whenever anybody represents to you that they're a small company, just make them sign something small, right? That says, you have made this representation in truth and in good faith. God bless you, sir. In the event that this turns out to be untrue, you shall not come back to me for anything, including penalty and interest. Let them sign and put it in your file. Just so avoid the nuisance value of having to deal with that subsequently. Thank you very much.
I'm so sorry, Taiwo. I have one small question. My name is Rachel Gbadibo. I work in the real estate space. Service charges. Now, service charges are, they're deposits you collect from your tenants, you keep them, and you use them to run a property. Now, what then happens if you have to pay an artisan, for example, and this is coming out of the service charge? How do you deal with issues to do with that? I'm so sorry. It just came up when you were speaking, please.
Yeah, so that's something that you should treat as a pass-through. So, yeah, because one, the service charge is to help you do certain things on behalf of certain people. You do not have all the skills. In fact, nobody expected you to have all the skills, so which means you stand in the middle, find the people with the skills to render the services. Those guys could have engaged that service provider directly without using you. So there should only be one incidence of VAT, right? So when that service provider is invoicing you, they should put VAT if it's a vatable service. If they haven't put VAT under the new dispensation, you have to self-charge it. Yes. So now, when you're trying to recover that money as part of the service charge, you do not put any further VAT because the VAT on it has already been paid. Your VAT will be limited only to your own margin or service fees or management fees, as you may call it. Yes, that's the simple. By the way, your industry is, in my view, one of the biggest beneficiaries also of the Finance Act. So you have the Real Estate Investment Trust. You also have now the withholding tax on construction of building, bridges, power plants, and roads, reduced from 5% to 2.5%. In addition to that, I also think that you can make a compelling case now more than ever before, at least for a few years before now, to demonstrate that the returns on investment in real estate is competitive. It didn't used to be competitive before because I can do treasury bills and make 18%. Now the rates are down to like 4 or 3%, right? So a few tips from me. You're welcome.
Good morning, everybody. At this point, we would like to say a big thank you to Mr. Taiwo Oyedele for making our time to come for our DBS Detailed Business Series today. We know that he's a very busy man, and unfortunately, he has to leave us now and go to the Eco Hotel for another engagement to the SEC. So at this point, on behalf of the firm, we'd like to say a very, very big thank you for taking time out to come speak with us and enlighten us on the Finance Act as well as the fiscal outlook for 2020. Thank you very much, sir. We'll just take quick pictures before you leave. So I'd like to invite Mrs. Kukoyi and Mr. Jeremy.
Thank you so much, Mr. Oyedele. Thank you. Thank you, Chukudi. So we'll be moving on to the next presentation for this session. If you look at your agenda, you'll see that we'll be having an overview of the Finance Act. This session is going to run through the changes that have been made. And we have two experts that will be taking this session. We have Chukudi Ofili, he's the associate partner at Detail Commercial Solicitors, and we also have Anthony Ezeamama, he is a senior associate at Detail Commercial Solicitors. So we're going to go straight into their session. Please help me welcome Chukudi Ofili.
What the Finance Act is about, what it seeks to achieve. interestingly, his presentation is more from an economic outlook. So what to expect, how to plan for 2020 and beyond. But as lawyers, we still have to do our bit. Our bit is look at it from a legal perspective. So we're going to do is in two parts, essentially. So the first is to look at the implications of the changes to the different legislation, tax legislation. So it's like a point-by-point breeze through the Finance Act. And then secondly, we're going to do a sectoral analysis. So what we're doing here is how does the Finance Act affect the different sectors? So SMEs, energy and utilities, the real estate space, and digital services, more importantly. So, provision of digital services. So I'll be doing a quick introduction. So the Finance Act was signed into law by the President on 13th of January. And we understand that that's the same commencement date. So interestingly, the gazetted copy was only made publicly available sometime in February. What it then means is that some of the provisions, or most of the provisions of the Finance Act would have a retrospective effect. So the only one that would have come into effect as at 1st of February is provisions relating to the VAT Act. And that, raises some legal issues. So if a law says it commences on the 13th of January, what then happens to transactions which were done between the 13th of January and the 1st of February? So what VAT rates would apply? So for that, our view is that the commencement dates on the Act should be that which prevails over a mere publication made by the federal government. So that's not gazetted, that's not done under any legal instrument. So we're yet to see how that will pan out. So chances are that we're going to have disputes that will arise from that, except the FIRS sort of waives that requirement for the period of the weeks before the 1st of February. The Finance Act made sweeping changes to provisions of the Companies Income Tax Act, the VAT Act, the Petroleum Profit Tax Act, Stamp Duties Act, the Capital Gains Tax Act, and the Customs, Excise, Tariff, etc. Consolidation Act. We've heard a lot about the objectives of the Finance Act. Primarily, one of the core objectives is to raise revenue for the government. Secondly, to promote fiscal equity, reform our tax laws. As we heard, we've not done any significant amendments to our tax laws since 1999. So this is actually groundbreaking and very significant. So the Finance Act also seeks to introduce tax incentives and essentially support small businesses. A lot of work has been done to do is to introduce incentives, ensure that small businesses are able to survive and thrive. And it will be interesting to see how that pans out. So in Nigeria, we typically have fantastic laws, more often than not. But the problem is always with enforcing, implementing the laws. So it will be interesting to see how the FIRS works with the federal government to ensure that these objectives are met. So to take us through the changes that have been made and the implication of the changes, I'll invite Anthony. Anthony is a senior associate and essentially works in our tax advisory unit.
Good morning, everyone. I'll be taking us through the Finance Act from the perspective of highlighting the changes made to these laws that have been listed here. I will start with the Companies Income Tax Act. The first one is tax identification number, now a requirement for opening and operating a bank account in Nigeria. This has been the practice before now. So what the Finance Act has simply done is to just make it a statutory requirement so that if you do not have or obtain a TIN, then there is a legal sanction for doing that. There is a generic provision under the CETA for failure to comply with provisions of the Tax Act. On one hand, this is good for the government in the sense that it helps them to monitor transactions. On the other hand, the federal government has been pushing for financial inclusion agenda with a view to capturing several Nigerians to patronize financial services. A situation whereby you are saying that someone in a remote community that the person needs a team in order to do his business. Where is he going to get that team from? Tax station where? In the village or township. So this is a real issue in terms of implementation of this law. Another issue here, which we talked about, is the expanded scope of the Companies Income Tax Act as it relates to non-resident transactions. Before now, the basis for taxation of non-resident companies is that such a company should have a physical presence in Nigeria, either directly or indirectly. So to the extent that a non-resident company can be associated with either a human being or a facility and the likes here in Nigeria, that person will be deemed to create what we call permanent establishment or fixed space. What the Finance Act has done now is to expand that scope to also capture people providing digital goods and services. So a situation whereby someone is sitting in US or China and providing a service here in Nigeria, or selling music or whatever in the internet, that transaction will be exposed to tax. Compliance perspective, what should I do as a Nigerian? The safest thing to do in that instance is to ensure that you withhold tax on such transactions, because until the finance minister tells us what the meaning of significant economic presence, the best approach is withhold tax in order to save yourself. Excessive dividend tax. The practice before now is that where a company does not have a taxable profit because of one reason or the other, and if the company goes ahead to declare dividend, the amount of dividend declared will be considered as the company's taxable profit, and that dividend will be subjected to tax. This has changed. So this double taxation, so it is immaterial before now that dividend has suffered taxing before. Now, once a company is declaring dividend that has suffered tax before, that dividend will no longer be subjected to further tax. There is an incentive for agricultural companies. Now, let me talk about these non-deductibles. Essentially, in computing the tax liability of a company, the company is required to take out some of expenses the company incurred in earning income as a deductible expenses. But for some, the law says that you cannot deduct those expenses, that they are non-deductible. So the Finance Act has widened the scope of some expenses you can no longer deduct in computing your tax liability for the year. Those expenses include penalty. So if you are fined for breach of any law, that amount paid cannot be set off against your income for the purpose of determining your taxable liability. Interesting one, commencement and cessation rule. Under the old provision of the Companies Income Tax, companies that commence business are taxed in a certain way, which is called the Commencement Rule. So essentially, the first 3 years of the company's operations is calculated, you determine the profit by applying this rule. And when you apply the rule, it gives rise to double counting and double taxation. You find a situation whereby the company is paying tax twice on the same income. So this rule has now been removed. Essentially, the basis for taxation now is in accordance with the company's accounting period. Carrying forward losses. So when a company incurs a loss, ordinarily, the company, if you do not have sufficient profit now in order to cancel that loss, so you are allowed to keep on carrying forward that loss until any time you are able to relieve the loss. But there is a provision somewhere, hiding somewhere in CETA, that says that you are restricted from carrying forward your losses to a maximum period of 4 years. An amendment was made to CETA in 2007. Unfortunately, they left out that provision. Now that provision has been deleted. Also, minimum tax. The basis for calculation of minimum tax has now been made very simple. 0.5. So minimum tax is essentially payable when a company does not have a taxable profit. So if you do not have a profit, FRS will still tell you, give us something, no matter how small. That is, in other words, called minimum tax. Now, minimum tax is 0.5% of your turnover. Related party business reorganization. In a typical business reorganization like merger, acquisition, and all sort of transactions, there are multiple taxations that will typically apply in that kind of that kind of transaction. You typically find VAT. You find issues of balancing charge and the rest of them. So what the Finance Act has done is that, to the extent that the transaction taxes are made a period of 365 days before the business reorganization, and also you must not dispose of the assets you acquired in that process 365 days subsequent to the transaction. Small companies. So companies that earn gross turnover of 25 million or less are now categorized as small companies, and they're exempted from tax. Medium companies, that's companies that earn gross turnover greater than 25 million, but not up to 100 million, will only pay 20%. Large companies, the position remains the same. You pay 30%. However, the fact you're a small company does not relieve you from complying with your tax obligations, like filing of tax returns and the rest of them. So what that then means, which Taiwo explained earlier, is that if you are dealing with a small company, you cannot withhold tax on payment due to that person. So the question then becomes, how do you know that someone is a small company? I'm going to talk about certain things in this respect if I go forward. VAT. VAT now 7.5%. Now, there is now a requirement that you register for VAT when you are commencing business. Before now, the law says within 6 months. Now, it is upon commencement of business. And the sanction provisions in the VAT Act has been increased substantially. Failure to do so, 50,000 naira in the first month of default. Subsequent months, 25,000 naira. If you are ceasing to do business, you are required to give FIRS notice. Supply of goods and services. The meaning of what amounts to supply of goods and services has now been expanded. I heard a gentleman asking a question about destination principle and origin principle. Before the amendment, this amendment of VAT, most companies that provide services from offshore locations were able to escape tax on the basis that there is something somewhere in the law there that talks about physical presence. So they will always argue that to the extent that we do not have physical presence in Nigeria, then that transaction should not be subjected to tax. There are two notable cases here. We all know Vodacom versus FIRS and Gazprom case. Now, what the law has done is to codify the position whereby somebody is providing services from offshore location to come under any exemption threshold to say that Taiwo mentioned this earlier. So there is now a requirement that if your transaction is less than 25 million, you are no longer required to do certain things you were required to do before, which includes 1, registration for VAT, 2, charging VAT on your invoice, 3, remitting VAT to FIRS, 4, rendering VAT returns. So once your transaction is lower than that threshold, now the law says that you are exempted from all those obligations. But I think I should make this very clear. There is a distinction between being a VAT agent for the state, because that is the obligation you are now relieved from carrying on. The obligation to still pay VAT on your goods and services remains the same. That doesn't move. Then this will now create a problem. So a situation whereby I cannot charge VAT, for instance, but in buying, so let me use a retail store for, let me just use this language loosely, a small company. If that person paid VAT when the person made his purchase, but upon the sale of that product, the person cannot charge VAT, then the person has collected, the person has suffered impute, what we call, when you sell the product, you charge VAT, then you take out what you paid from what you collected. Now, you have a situation whereby the person is paying VAT, but the person cannot charge VAT. What then happens to his impute VAT? How do you recover that? We are waiting for the FIRS circular. Okay, so there's another point here. For the first time, the law has included the provision that if you have excess impute VAT, you can now get a refund. Before now, what happens is that once you pay VAT by mistake or pay any tax by mistake, and that money enters into TSA, it is gone. FRS will tell you that you require an appropriation from the National Assembly to get that money out. That is the law. But that has changed. You can now make an application to get that refund, and you can also use that to offset your future taxes. I mentioned earlier, failure to comply with VAT Act, the penalties has now been increased. There is this very interesting one, definition of goods. The definition of goods has now been expanded to include both tangible and intangible goods. Let me give some perspective to this. There is this notable case on this issue, the CNOC versus AG Federation case, whereby the sale of contractual rights was held not to be a vatable transaction because incorporeal rights are not goods. Now, this has now been expanded. The definition has now been expanded to capture both tangible and intangible goods. So with that, your transaction most likely may not come under any exemption qualification. Basic food item. This has always been a very, very contentious issue in the past as to what amounts to basic food item. I recall there was a transaction we did, and FRS asked the person to pay VAT on, let me use this, milk, because the milk has undergone a process and whatever. We argued from here when the point that milk qualifies as a basic food item, and for that basis should not be liable to VAT. But what the law has done now is to set out a whole lot, about almost 100 items are on that list that qualify as basic food item. Okay, I'm going to talk about the change made to Customs Excise Tariff ETC Consolidation Act. So essentially, customs duty is paid on goods imported, while excise duty is paid on goods manufactured within a state. And typically in Nigeria, excise duty is charged on alcohol, tobacco, and the rest, maybe to discourage the production of those goods or services. And you'll find a situation whereby, because excise duty is paid on those items, people import these items and they escape excise duty because it is an imported item. It doesn't come under the qualification of goods manufactured within a country. So now, what the Finance Act has done is to expand the scope to say that excise duty includes goods imported and goods manufactured locally. However, there's an exception. It says excise shall not be paid on goods that are not locally produced in Nigeria, any raw materials that are not locally available in Nigeria. Stamp duty. The main thing with stamp duty is that the law tries to incorporate electronic transactions. So, for instance, instrument has now been given a wide definition to also include electronic instruments. Stamping has also been expanded to mean electronic stamping. Also, there's also a requirement that electronic transfers on India is exempted. I'll call on my colleague Chukwudi Ofili to discuss, to give a sectoral analysis.
Okay, so we've heard the changes that have been made by the Finance Act. So the next question I know a lot of people will be asking is, how does this affect me? How does this affect me in the industry within which I operate? So what I'll be doing here is just, taking a look at some of the key. The key change here is with respect to dividends that are shared to shareholders in petroleum and oil and gas companies as well. So in the previous dispensation, what you had was, once profits of a petroleum or oil and gas company has been subjected to tax, that's PPT, when the dividends are being distributed to the shareholders, it will be exempt from tax, right? So no withholding tax will apply at the former rate of 10%. But what the Finance Act has now done is that it will now attract 10%. So the question then is, in the oil and gas sector, if you take this together with the changes that were introduced by the Petroleum Offshore Production Sharing Contracts Act, which seeks to increase the royalties that will be paid in the oil and gas sector, you can then see that the government is actively looking to raise more revenue from the oil and gas space. So at the panel session, we'll be considering what next for oil and gas companies. What should they be doing? Should they be looking to, are we going to see a lot of more divestments? Are we going to see a lot of activities in the oil and gas space? So we'll discuss that during the panel session. The next sector, digital and electronic services. So the challenge with this is that significant economic presence is just a phrase, right? And it's left to the discretion of the finance minister. So what they're drawing from other thresholds, so their threshold at the time was 500 million euros. And then the OECD, I think, is 750 million US dollars. But the reality is that in Nigeria, we cannot adopt that because those thresholds are very high. It will essentially mean that everybody that comes to do some sort of consultancy or provide digital services will go scot-free, right? So we expect that the finance minister is going to sort of toe the same line, but the threshold would be a lot lower. But we cannot really predict what the threshold would be. So we should expect to receive some guidance in that regard. Again, that point goes to whether or not our tax system accords with some of the international best practices. So one of the principles of a good tax system is certainty, right? So if non-resident company that provides digital services cannot tell if it's going to have significant economic presence in Nigeria, then there are challenges with whether or not it should even, or how it should operate in Nigeria. Because the question is it liable to tax? For the Nigerian companies that receive these services, how do you comply with the requirement that you're supposed to charge VAT and issues like that? The next sector is the real estate space. So on the slide, we have a lot of technical terms here, which, I mean, if I try to go into that, it might confuse a lot of people. But essentially, what it's trying to do is to encourage investment in the real estate space. So we have a concept or entities known as real estate investment companies. So real estate investment companies would essentially be funds or vehicles where, so they raise funds from the general public. So this puts it at a very granular level, and then they invest the funds or proceeds received from shareholders in real estate projects. So either in real estate assets themselves, or in companies that would then develop the real estate assets. So essentially, what it does is the proceeds that come to the real estate investment company from its investments would not be taxed, so they'll be tax exempt. So the only tax that would apply is when the proceeds from the real estate investment companies are going to the shareholders, and that will be withholding tax at 10%. So essentially, what is done is to remove multiple layers of taxation and make it more. So it's an incentive for people to, take part in real estate activities, invest in the real estate sector. So for banking and capital markets, the changes relate particularly to a category of transactions known as regulated securities lending transactions on the one hand, and then changes with respect to the level of tax exemption that will be allowed on interest for foreign loans. So for the regulated securities lending transaction, you typically have, so permit me to use this, just, it might help understand. So you typically have, not all the time, but most times, you have 3 entities. You'd have the lender, you'd have a middleman called the agent, and then you have the final party called the borrower, right? So for the regulated securities lending transaction, what is essentially saying is that all proceeds that would come to the lender, so proceeds either from the borrower, this way, or from the agent to the lender, will now be tax exempt, right, on the one hand. It also says that all payments received by the agent, right, either from the lender or the borrower, would be tax exempt, insofar as the payments or the proceeds that it receives from either of these parties is on behalf of either party and not for its own accounts. Right? So that's tax exempt as well. However, where the lender or the borrower are making payments to the agent, so another set of transactions. So from the lender to the agent, forgive my distorted arrows. Right. For the account of the agent, that's for its own use, not for own transmission to another party, right? It would then be taxed it would be taxed accordingly because it's for the benefit of the agent. Exactly. So you'll be taxed for the agent. So dividends distributed by unit trusts are tax exempt. There are some rules about what is tax deductible and what is not tax deductible. That will be a long explanation, but I mean essentially it's just to say that payments made by the borrower to his approved agent or a borrower in a regulated securities transaction will be tax deductible. I mean, we'll share these slides because of time. I'll just keep those. But there's one last leg, which is where the lender is making payments directly to the borrower. He has an obligation to withhold tax. Right? That's essentially what the last one point is saying. So remember I said there are 2 legs here for banking transactions. So the next one is for foreign loans. So in the previous dispensation, what happened was when you're structuring the foreign loan, you could structure it in such a way that you would enjoy 100% tax exemption on your interest payments. If you made your repayment period above 7 years and your grace period was not less than 2 years, you would have enjoyed 100% tax exemption on the interest payments that you are making to the foreign lender. But what the new act has done is to reduce the exemption, the amount of exemption that you have to 70%. So the maximum you can get, irrespective of how you structure cross-border transactions is that the most you can get is 70%. I mean, again, ties into the objective of the act, which is to generate revenue. Right? So there are two other categories that perhaps are worthy of mention. Thin capitalization rules, have now been introduced by the Finance Act. Mr. Oyedele touched on this briefly, and then we had terms thrown around like EBITDA, and I'm sure a lot of people are wondering what that is. So EBITDA essentially means earnings before interest, taxes, depreciation, and amortization. But essentially what the thin capitalization rules, the mischief it tries to cure is where people structure so essentially what you choose would depend on which is cheaper. Right? So in structuring debt transactions, essentially, people would use connected party transactions such that what would have accrued to the, so if you have a entity, so the offshore entity would have provided a loan of your income, and then all of that would just go. Even if you say your interest rate is whatever figure, right? The only portion that will be allowed for you to deduct in computing your CIT would be 30% of your EBITDA. So whatever is in excess of that 30% of your EBITDA, you'd have to carry it over to the next year. So which means it's no longer an incentive for people to structure transactions that way where they can just route funds, offshore. So essentially, it ties again into the objectives of the Finance Act, which is to ensure that they can, certain structures like what I've explained. So that's the end in terms of the sectors and how it applies to the sectors. We hope this has sort of set a good platform for us to have conversations with the panel. So the intention here is just to sort of throw up some issues which we think able panelists would discuss in depth. So I think at this point we'll move to the next session. So I'll just do a quick introduction of the panelists that would have today. In no particular order, I would start with Mr. Guy Bertrand Joya. Mr. Guy Bertrand. First thing I noticed about him is outfit and how he represents his organization. So thumbs up. So Guy Bertrand leads the finance function and is in charge of all aspects of Mark's NG's financial operations, including budgeting and financial planning, accounting and reporting, treasury and cash management, fundraising, and access to finance, investment, and capital allocation. He has close to 15 years of experience across investment banking, financial advisory, M&A, structured financing, and strategic consulting. Prior to joining Marks, he was the CFO of Tarragon Group, a Pan-African data and marketing technology company where he successfully sourced and arranged the company's Series A provider. Guy Bertrand built his career in investment banking and strategic consulting, starting at French banks, Credit, Mutual, CIC, and Natixis, where he advised on numerous M&A, capital markets, project finance, leverage financing, everything finance in as many sectors as possible. And he has tremendous experience, across many countries in Africa. He joined PwC in Lagos in 2013 as a corporate finance consultant, and then proceeded to found a strategy and financial advisory firm focused on helping fast-growing companies solve the challenges of scale across the continent. Interestingly, he holds a mechanical engineering degree from the University of Douala. He is enrolled in the joint EMBA program of London and Columbia Business Schools. Let's welcome Mr. Guy Bertrand again. We also would like Bimbola Ogundare. She's the Director, Transaction Advisory Services, West Africa in Ernst & Young. Abimbola is a senior level executive with extensive experience in M&A advisory, transaction structure, due diligence, financial modeling, business case assessments, buy-side transaction advisory, disposal advisory, valuations, and business planning for a whole variety of private and public sector clients. With 15 years financial advisory experience spanning investment banking and consulting, she is the consumer market sector lead for EY's West Africa transaction advisory practice. As we all know, EY is a global leader in assurance, tax, transaction, and advisory services. In her capacity as consumer markets lead, Abimbola has advised several private equity and strategic clients on their acquisition, structuring, and pricing strategy. She's passionate about helping local companies scale and institutionalize on their growth journey, and has facilitated several scale-up sessions for Faith Foundation entrepreneurs. And she recently delivered a federal government of Nigeria-led public policy initiative to recategorize and refocus MSME procurement-led opportunities across Nigeria. She enjoys interesting perspectives from conversations with her adorable 6-year-old daughter. Would also like to invite Mr. Tola Akinomi to the panel. He's the head real estate finance, West Africa, Stanbic IBTC Capital Limited. Tola is an investment banker and has had various roles within corporate and investment banking with specializations in real estate and Côte d'Ivoire, which spans across various asset classes with an estimated portfolio size of over 1.5 billion US. In addition, his project finance deal mandates include debt capital raising for major infrastructural projects in oil and gas and industrial sectors. His early work experience includes treasury operations and commercial banking roles in Fidelity Bank, University of Lagos, his postgraduate diploma in project management, and MBA in real estate and construction management from the University College of Estate Management, Reading, United Kingdom. His research project themed Africa the Next Frontier focused on the impact of real estate funds on commercial real estate development in sub-Saharan Africa. In addition, he has attended a number of dedicated real estate training and conferences, both regionally and internationally, including the Real Estate Management Program, Finance, Design, and Leadership at the Harvard Business School. He has been actively involved in a number of real estate industrial advocacy committees set up to engage key regulators to unblock constraints to catalyze the growth and development of real estate investment trusts. He's a member of the Urban Land Institute. Our final member of the panel is Mr. Victor Ndukauba. He's the Deputy Managing Director of AfriInvest West Africa Limited. Victor supports the group's strategy and business development in his current capacity as the Deputy Managing Director of AfriInvest West Africa and provides senior oversight on the group's information technology as well as finance, risk, and control functions. In addition, he continues to play a leading role in origination and execution of investment banking transactions, drawing on his experience in corporate and project finance advisory, as well as capital raising. He began his career with the Corporate Finance Business Unit at the Lagos office of PwC in 2005, where he advised a variety of clients across several sectors, including financial services, telecoms, FMCG, food and beverage side of the FMCGs, hospitality and real estate. He was also directly involved in early stage transaction support services, including financial and accounting due diligence, as well as carrying out financial feasibility studies and business plan preparation. He subsequently moved to AfriInvest, where he joined the financial advisory practice in the investment banking division in 2008. He served as the head of AfriInvest investment research between 2009 and 2011 and led the asset management division of the Pioneer as the Pioneer Managing Director, following its spin-off as a wholly owned subsidiary. So we'd like to welcome all the panelists. A round of applause one more time for them. Okay, so I'll be moderating this session. So I'll just ask questions. flowing from our presentations as it relates to the different sectors that they operate in. And hopefully we would have a very interesting conversation that will address some of the issues that, a lot of people have been, thinking about. So I would start with Mr. Tola. So a lot of people are interested in the real estate, sector. A lot of people have some sort of investments in one asset or the other. What are your thoughts about the Finance Act and how it affects, the real estate sector? Just your general thoughts.
Thank you very much for this conference or for this engagement. There's been various thoughts, and I think in summary, one can say that speaks to real estate is the fact that in relation to what is done for REITs, and I'll say, there's been a lot of work in progress. Stanbic, IBCC Capital, and a couple of other stakeholders have been engaging both the SEC, the FRS, in trying to reform that asset class, and it started from working with the SEC to define the rules and also engaging with the FRS through letting them understand that you're not giving up tax, because on one side you're doing a pass-through, but really while it may seem you're giving up tax, it's just fairness of access that can come to the market, so the financial the money market. So in so doing, you're now seeing a situation where real estate investment, which either wasn't comparable to TB rates, now becomes. There's also capital appreciation that you get in real estate. So if you add that, from time it was always more comparable or favorable to TB. So having that pass-through means that we're able to enter the market, or the Nigerian real estate market can then be comparable to what you see in other global markets, which is that pass-through element. When I think what it will create is you're stable, and people are able to find that exit. So with that instrument being available, you will then be able to see churning of activities, capital flows come, just increase the pie. Retail investors can participate as well as institutional investors. And at the end of the day, that just creates value. And you create a market where we don't only have traditional investments like stocks and bonds, and begin to see all the alternative asset classes coming in. So I think it's a very timely opportunity. I think there's still more to be done, and I think we'll still touch on that as we go further down. Thank you.
So just would depend on whether or not they are registered and regulated by the SEC. Is that correct?
No, I think what has happened is, one wanted to, because the SEC, which is, the risk regulator that manages and regulates as either a REIT of REITs, is that it can either be define the parties that will participate, the various nuances around it, and then the FRS can then, on the back of, they are focused on taxation, right? So they can focus on delivering what they've delivered now and tying who benefits. So you don't want a situation where it's not populated, you're not distributing cash flows or rental streams, and you're getting that benefit. So I think that was the whole purpose of strictly getting those definitions right.
So moving to investments generally, and the Finance Act, and how does it
certainty, and that it is uncertainly defined as it is in line with the general context in the country right now of uncertainty. It should be concerning for any company that's in to perpetuate that context of uncertainty and that context of policy by fiat, policy on the whim. It is very hard to foster long-term growth, long-term investment in such a context. So that's one area of concern. Another area of concern is generally the fact that the impact of VAT on really the lives and the economic viability of the most vulnerable people in the population. So I know there's an extensive list of items or goods that are exempted. There's an even longer list of things that aren't exempted. So for instance, in our case, as a mobility company, for example, the question is, that pay to use our service, or our drivers, that pay to access our platform and some of our services, which of those things are exempted, which of those things aren't exempted, right? And how does that impact the affordability of the service? I'm speaking globally, I'm speaking nationwide across Nigeria, I'm not speaking of Lagos. Yeah. So noting particularly that outside of it's of an even bigger concern outside of Lagos, because outside of Lagos generally the average income is lower than in Lagos, right? And it's not even like in Lagos it's super high. Let's not kid ourselves. We fully understand we fully understand what the government is trying to do. They're trying to solve problems. They are not in an easy position. The country is in a very difficult, fiscal position. We can't ignore that, and it's a problem they're trying to solve. Now, we can discuss whether that's the right approach or not. I have my views on that. I think that we remain a bit too focused on basically extracting extracting more out of the little value that's created, more so than finding ways to create more value. That's the problem. Yeah, those are my views.
Okay, just taking a cue from that. So to the extent that there's a bit of uncertainty, what steps? Sorry?
A bit?
A lot of uncertainty. A lot of uncertainty. So to what plans are you making? So in terms of tax planning, are you taking any initiatives? Are you taking any steps to sort of cushion the effect on your end users, your drivers, as well as the company?
We believe in generating wealth, in creating wealth. We believe in creating a platform where people are able to to have a form of employment, to generate an income, to better themselves. That's what we believe in. That's what we're trying to do. That's our mission. It's a key part of our mission, right? How to empower people, how to empower our drivers, how to empower the people that use them, right? People need to move around, because if you have a job, you need to get to your job. If you don't have a job, you need to go to your interview, right? If you're a driver, you need to move from being in the informal sector and at the mercy of all forms of rogue and official operators, to an environment where you operate within the ambit of the law, and therefore you sort of like disempower those actors. That's what we believe in. So for us, is really what can we continue doing? What can we do to continue generating, incremental, amounts of wealth for our stakeholders, right? For our users, for our champions, for ourselves ultimately, and then for our investors. So that can be done. We think the problems that we're solving are problems that exist across the continent, right? There are problems that exist in Lagos, there are problems that exist outside of Lagos, there are problems that exist in Kano, there are problems that exist in Enugu, in Maiduguri, they exist everywhere, they exist across Africa, right? So our focus is really solving those problems at scale and really impacting more and more lives. If we do so, paying 5%, so 7.5% will solve itself. But now we need to be allowed to solve those problems.
Interesting. So we're moving now from transportation. So we've seen that the Finance Act perhaps does not address, some of the issues related to the transport sector, right, in terms of VAT. But I understand that the Finance Act actually does a lot for the FMCG space. So, Bimbo, could you please just let us know what you think would be the effect of the Finance Act in the FMCG space? Do we expect to see a lot more growth? Do we expect to see a lot of business reorganizations, mergers and acquisitions? So how do you think it's going to play out?
So thanks, Chukudi. I would say that the FMCG space is one of the significant beneficiaries of the provisions of the Finance Act, right? And I would look at that from the perspective of the medium or larger companies and from the perspective of the SMEs, or the MSMEs as they should be called, because there's the micro segment as well. From the perspective of the MSMEs first, what we hear is companies with gross revenues of 25 million and above are now exempt from tax. And that's a welcome development. If you put that in context of the MSMEs as a driver for any economy, especially an emerging economy, right? In Nigeria, the MSMEs account for, I would say, between 70 to 80% of labor productivity. So if you have 10 people in a room in employment, and maybe not in this room, 8 out of those 10 people will be employed by an MSME. If you're able to formulate policies and make decisions that positively impact the MSME, you're impacting the lives of 8 out of 10 people from a labor productivity standpoint. From a GDP contribution standpoint, MSMEs in Nigeria contribute anywhere between 45% to 50% of the GDP of the country. That's significant, and it's in line with what you'll see in emerging markets, where MSMEs contribute around that range, right? In India, they contribute about 60%. So if you put that in context and you then say, who is the typical Nigerian MSME? So from the micro segment, and this is based on a recent study that was done by the Federal Ministry of Investment and Trade last year, and it was funded by the UK Aid. I know that Taiwo mentioned in his presentation that there are some esoteric things like Brexit and coronavirus and so forth that you can't immediately explain how they would impact the local businesses in Nigeria. But if you look at from the perspective of Brexit, for instance, the UK will be looking for new trade partners, right? And if the new AFCA, the African Trade Agreement that we have, then positions us to do business more fluidly within Africa. And there are bigger economies that are looking for trade partners at this point in time. We're able to leverage on certain levers that can position us to deliver that value. So for SMEs, they contribute about 10% to the total export in Nigeria. And that export, about 40% of it is cashews, sesames, cocoa. Where does all that go? Where does cocoa go? It goes to Europe. It goes to the manufacturers of chocolate. So if you create a path from MSME with immediate low-hanging fruits like, as you start out, don't pay tax. As you get bigger, you start to pay tax. But I'm bringing you into the tax net ab initio, because remember, from a VAT perspective, you're going to register. You may not be liable to pay the taxes, but you register. So I have some visibility on you. I see who you are within the eco space, and Nigeria is an informal market. So 60% of the businesses are informal. They have high mortality, you don't know who they are. But if you're able to bring them in, you know who they are, and you can see how they grow. Those businesses, for instance, the guy that does the cocoa in the north is a smallholder farmer, right? And he's keyed into a value chain where someone aggregates and exports to Europe or other jurisdictions. If you're able to grow that guy as an SME, then that's a positive impact on your consumer markets in the first instance. And then you look at larger companies. So a medium-scale company would earn anywhere from 100 million to 500 million in revenues. But what that also means is that company is on the path to become your next local conglomerate, or to support the multinationals that you have. And if you're able to position that guy to pay from 0% tax to a 20% tax as he grows, to the full-fledged 30%, then he's going to have some clawback and some growth capital along his journey to put back into his growth and contribute to. And when you look at, I'll take for instance, the locally produced female hygiene products, right? Those are now VAT exempt. So no input VAT, no output VAT. Now what that means is, from a competition standpoint, a Hayat Kimia, for instance, that produces locally manufactured female hygiene products may be more competitive than a P&G, maybe, just just hypothetical, that still imports some categories, but also manufactures some locally. By the time you look at the average cost of production, you'll find that a person that manufactures locally has some exemptions that can, and within consumer markets, don't forget that tiny levers, price, route to market, products resonance with the consumer make a significant impact on revenues. It's a volume game. So you may say it's 2 naira, but 2 naira across, 2 naira margin across half of the Nigerian population. We're looking at female hygiene products, right? Half of the Nigerian population is 100 million people. Let's assume that you're able to capture 10% of that market, right? Multiplied by the number of times a year that each person will use that, that's significant. So yes, I think consumer markets are a winner in this finance bill.
Interesting. So now we've heard from different sectors. I'm just going to talk about or ask a question related to the general investment climate. So I'll be asking Mr. Victor, what do you think about the Finance Act and the incentives that it has provided, particularly the incentive on retained earnings and the likes? So how does that affect foreign investments? How does that affect Nigerian companies? How does that increase the investment appetite, especially in the equity space?
Okay. So I guess the overriding sentiment from the reform is broadly positive, as it impacts very, very positively on several sectors. Like she's mentioned, FMCG, real estate is under one. The amendment to that double taxation, Section 19 of the Act, speaks to, and Taiwo touched on it, and you also mentioned it. It's the concept of holding companies, and the effect of double taxation, where you tax the holding parent company even if it's not operating, as well as tax the operating entity. So taking that out of the equation now, in the past, what people would do in structuring transactions is typically to position the holding companies offshore. And so that way, there is no benefit to the Nigerian economy from a tax perspective. Now with this amendment, it may perhaps have a positive effect, but the challenge, however, is that for investment climate, fiscal rules are just but one element of the consideration. The broader macro considerations, obviously, around the stability of the environment in terms of policy, even just the process, the practical process of actually inflowing capital. For Nigeria, unfortunately, the macro picture has been sort of clouded over the last 5 years, and some of the key variables that have sort of clouded that outlook include the fact that the dip in oil prices had a negative effect on the currency, and so we continue to be in the sort of shadows of a currency devaluation equation. The concerns around that continue to hover, more so if you've paid attention to the last 3 quarters, the country has had a negative current account position. The last time we had that was in 2015, in the build-up to what was a devaluation that hit us almost 70%. And that ties into the presentation earlier by Taiwo, where he touched on the fiscal position of the country. So last year, you look at the budget and look at actual revenues, 7 trillion budget for revenue, you achieved 4.8 trillion, nearly 40% down. You budgeted to, for the deficit of 1.9 trillion, we ended up doing 4.8 trillion.
The question is, when we look at the capital markets and what the federal government did in terms of borrowings, there's still a gap. And what is now apparent is that the central bank has been printing money to fund the federal government, which in itself also breaks the law, because by law, the CBN can only fund to a maximum of 15% of prior revenues. So it's a potpourri of problems. And I think, so from our view as an investment bank, we've always felt that there is a limit to what the federal government can afford to do on the infrastructure side, which really, so while the Finance Act is a fantastic, and I've always championed for this. I recall as a young analyst in 2005 reading the report by the then Ifeko Omoigui-led FIRS, where there were recommendations around some of this, amendments. I always felt, look, yes, it's important to reform the fiscal environment and lower taxes as much as it can for the small players, even down to the individual progressive taxes. I think the biggest headache we have as a country really is on infrastructure. So the ability to move goods and services and people around efficiently, in good time and in decent comfort is where we have a biggest challenge. So whether we call it roads or rail, it's critical. The second obviously is power. So years of building things, but you can only build things when there's power to drive it. So if we're going to fix the problems, there are still some very big elephants in the room that need to be addressed. Infrastructure, one, and the government's approach to dealing with infrastructure. So what the current administration has done is focus its energies in trying to leverage its way to fund infrastructure. Unfortunately, with the fiscal position as it has, there's only a limit to what it can do. The truth is, it needs to essentially step back from undertaking to do some things by itself and act more from a regulatory, lay the ground rules sort of perspective and allow other players come in, take that equity risk alongside the government, and then leverage up and begin to drive efficiency. Imagine let me use an example. The second Niger bridge is being done under a PPP model. The government initially wanted to build the project, but I know for a fact that in talking with the officials at the NSIA, the reason why there was a long delay in actually undertaking that project was project costing. When it was costed by government, it was done at almost 4 times the realistic value to deliver. But if you get a private sector operator to come in, because he knows he has a limited time to recover his investment, he's leakages. He's more efficient about how to deliver that infrastructure in good time, because the sooner he delivers, the sooner he gets to revenue, the sooner he can get his return. So there's a general pervading sense that private capital is evil. Private investors are greedy inherently. Yes, there's always the enlightened self-interest, but if we're able to harness the power of private capital, private investments properly, we can deliver so much more infrastructure in good time to be able to unlock the potential of this economy. There are softer areas where government needs to invest and it needs to go. I think that's really where we need to start looking at things from.
Interesting. Thank you very much for your thoughts. Very insightful. Very, very insightful. Going back to real estate, the question is, what structures are best
to...
So how do you best structure a REIT now? How do you best structure a RICO with the advent of the Finance Act? What would be your advice?
That's so much of a technical question. But I think the simple thing is a REIT. So let's use the term REIT, and you can then take the form of whether you're a company or a trust. Okay. And the difference between both is that the company is more internally managed, and whereas in the trust one, you have external parties managing. You have a fund manager, you have an asset manager. But within a company, it's all ring fence, and it's more cost effective, right? While it's timely that the Finance Act has come, what we've seen in the market, and we've gone through a decade, possibly, or 15 years of massive growth where there's been assets that have been created. I mean, the retail malls, the offices, quite a lot of residential government hotels. So we're seeing, that being created, over the last few years. What we've also then seen following the recession is stress, and where asset values are, dipped, where rental values, luxury apartments in the case that we're going for $100,000 or more dollars are lower, where there are a lot of empty apartments, where there's increased vacancy, where just below where they are now, where the valuation has dealt an heavy blow on what the rental income are to investors. What that has created is depressed values, right? And given that, you then wonder, for those investors that built properties at values that were, where cost really is, to then come into list at, so you can only list those assets based on the rental cash flow, because that's what creates value. So I think there's a need
for the market to stabilize further,
and you get to a sense of normality, or where, when you raise that capital, because one essence of raising the capital is first to create liquidity for investors that are looking to exit, or to create new assets or acquire maybe discounted assets. If there's that value, so there are different things around it, then you might begin to see activities. So I think, beyond the fiscal bill, there are different things within the real estate market that needs to be fixed. Valuation is very critical, because if that isn't done, and where there is almost a common sense about what valuation standards are, one valuer cannot value this property, for example, at, let's say, 10 billion naira, and another valuer values it at, let's say, half. There has to be specific standards that and I think there's been a lot of work done to get to that stage. But what we will define as local standards has to also be comparable to international standards, because the investors you expect to invest in those instruments are not just local, they are also international. So that brings the required offshore investment that we're also looking at. So I think having that, then also creating liquidity in the stock market. You refer to what. So all those have to be fixed, because you have one asset class, it's not going to sell by itself. So liquidity, investor confidence, those are critical. And ensuring that those values continue to be created exponentially. And then the last thing I said was, which was the first point I made, ensuring that assets stabilize, occupancies are at the right level. We're fixing things around the economy, meaning that they were caused by exchange rates. Currently, we're already speaking of possibly whether there will be a depreciation of the currency. So those are the many things there. But overall, I do think that with the advent of the fiscal bill, with the fact that you've created that asset class or that instrument as an exit option, it then creates a path where assets have been created, the capital that have come in to create those can find a way out, and then that will incentivize more capital coming in. Because what investors have tend to ask is, if we bring in money, how can then grow the whole pie within the real estate sector?
Thank you very much. So we'll just pause for a bit and ask questions from the audience.
Sorry, dear. This one is for you. Quick question, very, very quick. So you mentioned treasury bills earlier when you were talking, and from the bitter experience of a lot of my clients, banks would not loan for. So my very, very quick question is, do you to lend to well-researched real estate projects? Because my biggest bugbear with the banks is that I don't actually feel they add to the growth of our economy. They just kind of take our money, give us a lousy saving rate,
and charge us masses of interest. So I have an issue with banks. I know you're my friend, but I have an issue. So,
so first of all, I'd like to say I'm a banking outfit. But anyway, I think that question is valid. You know, and from my perspective, and I think not all banks. So what banks do in the stereotype of what banks are globally is mortgages. You know, they provide and to the retail market to lend money to real estate requires a specific skill set. Not all banks have those skill sets, but it's easy to give the money, but can you manage the development cycle? Beyond the development cycle, can you also manage through the operational cycle? You know, plus what we're talking about now, what about the exit cycle? Because real estate is long term, it's forever. That's just the truth about it. And given the type of deposits that are within banks, you know, banks are not structured to lend long term to that extent. You need to find long term capital. So can banks do it? Yes, they can. You know, and what could possibly happen to the extent you have the skill sets to manage the real estate opportunities is to find or to match funding. I mean, we're beginning to, you know, I think where some of that being is also currency, where, you know, so what would have made real estate successful is the lower interest rate, which, you know, you could only find from a dollar loan, which has created its own problem. But, you know, that's why I think this period marks a massive opportunity for our local real estate players to ride the tide. You know, we're beginning to see rates below 15%, and that is the truth. And that's from the high of mid-20s. So while that's not the, I think, and what will develop the real estate, if our local developers can access lower interest rates, you know, then you'll begin to see that. And then the fact that the CBN has also made increased the LDR for banks. I hear it might even increase to 50 to 70. It's currently 65. Means there's a need, you know, to deploy capital to investment, and what makes sense is investment that are long, rather than someone that you would lend to in 90 days, trade back and gives you, and then you're trying to meet your orders every time. So I think, you know, what's important is for local players to structure, and everybody, you use the right term, properly structured investment, you know, would always find the capital, and I believe this is the time. So I hope that answers your question. Stanbic would fund you anyway, so you'll be rest assured.
We'll take our commission.
Good afternoon. My name is Enjara Sokafo. I work with Business Day. So I have two questions. The first is to all the panelists. So the Finance Act has been very much welcomed by industry stakeholders. So why it has prospects for FMCG and MSMEs, for transport industry, it brought the new 7.5% VAT rate. So I want to just ask you on the panel, would you say it's more positive than negative? The Finance Act, there's a lot of prospects for the real estate, but it basically just talks to rates. How would you say it can directly affect or impact on the prices of housing? Because, like you know, we have more than 20 million units deficit in affordable housing in Nigeria. So there are other key issues, although I like that you try to point that out. There are issues in the real estate industry. So why, for example, if an investor comes into Nigeria and comes to the market, because I feel like it has more opportunity for just the rates and the capital markets, because there are other issues that are going to constrain even investor coming in. If investor comes in and it gets real estate development, it will directly impact on the sector. Thank you.
So I think we'll take the first question first.
Sure. Is it a net positive for the economy? I'm not equipped enough to answer that question. I can answer it from my perspective, from the perspective of the sector in which we operate, which is mobility, not just transportation, mobility, and which is, tech-enabled businesses. For tech-enabled business, we are more concerned than satisfied, because as I mentioned earlier, I think there's a, right, for various reasons. So we look at it, with a bit of circumspection, with a bit of, caution, right? Now, is there a net positive for the economy? That's an entirely different debate, right? Because, I have a question. Will the finance bill on itself, like in itself, stem the tide of people migrating out of the country? The question. Will the finance bill by itself solve the challenges that my colleague mentioned? Realistically and holistically is an entirely different debate and will require like 5 additional sessions, in my opinion.
So I look at it from the perspective of a long-term journey. Given our history as a country, especially with policy formulation and implementation, there is the policy formulation part and then there's the policy implementation part. The time that it took to put this together and to get it signed into law, I think was commendable. It's not something that you see every day in Nigeria, right? And when you start policy reforms, I wouldn't say this is exactly a reform, but you start with low-hanging fruits, right? There's a short-term plan, there's a medium-term plan, there's a long-term plan. The immediate areas of focus or the areas where you can unlock the most benefits are probably where you want to start with. Yes, keep an eye on the ball, let the objective be in mind, but if you keep that in mind, and also I've heard that this is going to be an annual debate or an annual roundtable or an annual release. When these kind of gazettes come out, there will be a teething period. There will be a time where you need to assemble the stakeholders, understand where the pain points are, where there have been circumventions, where baby steps, but growth.
On that final part, and thank you for what you just shared. I mean, there were 2 different tweets, and there's always a short-term view, and there's also the long-term view.
Trying to relate that to real estate, as my colleagues have said, it's one aspect, and it's the fiscal aspect. It's meant to be a stimulus, and you will see the ripple effect come through. And which, it's so timely that it happened where interest rates are lower, the homo market rule that drove just too timely. So you mentioned about cost of housing, what production materials, what extent of imports, what infrastructure, transportation, roads, that private sector initiatives, those people that were in private sector that understand the challenges, that worked with government. And all we have seen is Buhari signing it, but there was a lot of work, and it's commendable.
Okay, I guess perhaps let's wrap it up. And but I think it has a broader, poignant, which is it's the first step. The understanding is that the Finance Act will be reviewed every year along with the budget. So for every year, a budget is proposed. There are still areas of concern. I think, for example, in real estate, one thing is I think there's still a fundamental question around, for example, land administration, acquisition and control, the entire process. So the Land Use Act is something that continues to resonate as a point of concern. And perhaps it is something that needs to be looked at quite closely as well. Because at the end of the day, you can't have a mortgage industry or a building and construction industry without land. That's the fundamental, terra firma on which you build everything else. So we need to look at that. As an investment bank looking into the market, we begin to recognize opportunities. And it's better, but all yield. We are all, look as if, we use developed economies. Morocco. I've visited Casablanca twice in the last 4 years. It will surprise you to know that inflation in Morocco is less than 2%. It's about 1.8, 1.9%. You have a mortgage industry that lends money at from 20 to 45 years at between 4 and that is fairly priced. $25,000, $30,000. The peak of the market about $200,000. So I think that to really address the housing deficit and to solve the problem of real estate, it really comes back to what I like to call the primary objective of the central bank: price stability. If we're going to solve that problem, we need to bring inflation to low single digits. It is the single determinant of everything else around interest rates and pricing. So this is a short-term distortion, which I don't think is sustainable. It might create some opportunities when you put it side by side, the review to the policy on lending, loan to deposits. But fundamentally, when you look at the balance sheet of banks, I recall as an analyst doing research, and I used to cover banks. On average, anything inside, I mean deposits, were typically short-term money. So it's CASA, current account, savings account. Most of those monies were, on average, placed with banks for no more than 90 days. To expect the same institutions to then take those monies and lend them for even 3 to 5 years, which is sort of where the banks play in the sweet spot when they look at their static deposits, is even already doing magic on their part. Create the right incentives that encourage the pension funds today to begin to look at real estate. This could be one start, but as an industry, we are all very keen to create that, and I have a selfish interest to do that as well, because I believe we need to create homes for young people like us. I don't have access to easy money or funny money that I can use to put down and buy houses. That's why I have a lot of empty property. So I think we're heading in the right direction. I believe it has to be concerted. The efforts that brought us to this point have been very concerted, but we need to continue to push collectively as an industry. Thank you.
So, I think this is a good point to wrap it up. We've had a great conversation around the Finance Act, how it affects the different sectors. We've heard from industry experts, and I think the great takeaway from this is that the Finance Act alone, whilst it's a good step in the right direction, it's not all that there is to do. There's a lot more work that needs to be done, and that should be factored into the long-term strategy and long-term plans of the federal government.
Interestingly, we've heard a lot from the different sectors,
but the key thing is the Finance Act is it's a law, it's a legislation,
and the role of lawyers cannot be overemphasized, right? So what it says is that
in as much as
we try to apply it to the different sectors, we make forecasts, the reality is that there must be some sort of certainty in the legal space. There must be, so for example, there are certain clauses, there are certain provisions, there are certain terms that you come in. So you need lawyers for legal advisory, that's transaction advisory, because in the banking and finance sector, you will probably have to do a lot of restructuring. You'd have to look at your documents. You need tax advisory from a legal standpoint, and that's where your lawyers also come in. So we've not had the opportunity to sort of go in depth into the legal, issues that would arise. So, for example, we've had clients come to us to ask us for opinions on the Finance Act as to how it affects their business. So, example, one of them is a company in the FMCG space. Something as little as how would you define cereal under the exemption list is something that can either make or mar your business strategy, especially for those on the distribution side. So, in as much as we have all these conversations, the role of the lawyers cannot be, jettisoned to one side. So, it's a fantastic conversation. We're happy to have had you, give us insights. And just to wrap it up, to say that we are also, to contribute to fiscal measures being taken. So, for example, we do a lot of engagement with the FIRS where there are some provisions of the law that are not clear. We need an insight as to how they would operate. There's a key, I mean, just on the side, there's whether or not you can charge input VAT and charge output VAT. So, classic example is you suffer input VAT before the Finance Act, right? And then you can't charge output VAT because some of these goods are now exempted from VAT. What happens to the business? What happens to you? So it's not clear what's going to happen, but the lawyers will then come in to have that engagement with the FIRS, interpret provisions of the law, you know. So more than ever, you know, I think it's critical that the lawyers play a very, very key role in the tax space. Beyond just consulting, there's the legal side to it, and it's very important that we are alive to our responsibility to ensure that there's that certainty for businesses like Max and the likes, so that people have they can plan beyond just 1 year, 2 years. So I hear everybody say that the finance bill is going to be, VAT rate is now 10% or 15%, or you find out that, for example, the oil and gas companies that can no longer, their profits are no longer exempt from the dividends are no longer exempt from tax. So you wake up in 2021 and find out there's some other thing that can affect a business negatively, and something needs to keep happening. Conversations need to happen, public spaces, private spaces, and then, I mean, they call on lawyers as well, and we are taking a lead in that, right, to properly engage the regulators and properly engage the legislature as well, so that some of these things are set right at the point of conversations about interpretation. So that's it for the panel session. Thank you very much.
I'm sorry, this is not on the program, but it occurs to me that we didn't take questions from the lawyers who gave presentations. Even though we're shutting down now, please engage them if you have any questions.
Good afternoon, everyone. So we're going to have 5 minutes of your time. One minute. Good afternoon, everyone. My name is Chizota Makwiwo, a solicitor at Detail. So we've come to the end of our 10th Detail Business Series on the Finance Act 2019 and its impact on Nigerian businesses. We started off with a presentation by Mr. Taiwo Oyedele, who took us through the physical impacts of the Finance Act. And then we had a session by Chukwudi and Anthony on thriving as a business in Nigeria. Sorry, I have 1 minute. Special thanks to our lead partner, Mr. Ayudido Oyeledu, the Detail team, and the rest of the staff here at Detail for planning this very engaging business series. I'd like to invite us for refreshment and networking in the room to your right. Once again, thank you very much, and we look forward to having you at the 11th Detail Business Series. Thank you.